People don't stop having needs. Absolutely. Well, it is noon. You are here with the webinar from Fort Pitt Capital Group. The webinar is Charitable Giving Options. And we are partly doing this in celebration of Giving Tuesday, which is a wonderful recent innovation. The idea being that, hey, as you get close to the end of the year, it's a great time to think about people who have a need, important causes that need attention, and tax considerations. So just to do a quick introduction, when we talk about charitable giving, Friedrich Nietzsche said that we can endure any how if we have a why, that we're at our best when we are bridges rather than ends in ourselves. Charitable giving is a wonderful way to give meaning to our means, and that's our focus today. So by way of background, I am Chris Cheney, a senior financial advisor with Fort Pitt Capital Group. Here with Bradley Newman, also a senior financial advisor with Fort Pitt Capital Group. My background is a little different. I am, as you can see there on the presentation, a CEPA, which is a certified exit planning advisor. I work primarily with business owners who are wonderful individuals who invest themselves in the community, invest themselves in the business. They just invest themselves, and it's always a delight to work with business owners. But before I started as a financial advisor, I had about 6 years where I worked as a fundraiser. In fact, my father was a fundraiser for over 25 years with a number of different nonprofits, hospitals, universities. So it really is something that is near and dear to my heart. It reflects both the passion for what nonprofits can do and for the importance of charitable giving. So that's my background. Brad, I'll turn it over to you. A little background about us and you.
Sure. Like Chris said, I'm Brad Newman. I'm a certified financial planner with Fort Pitt, and really been working in this industry for about 25 years, helping clients, kind of quantify and meet their goals. And like Chris, I'm so happy that we're doing this on Giving Tuesday. And as far as some of my charitable background, I am at present serving on the investment committee for our local United Way chapter, and on the investment finance committees and board for our local Ronald McDonald House. And beyond that, my wife has spent her entire career with the YMCAs, never collected a paycheck from another organization. So I really understand, the importance and the impact of charitable giving on, keeping these organizations going. Like Chris and I were talking about early on, just, especially in tough times like we've had. So just a little bit about Fort Pitt Capital Group for those of you who might not be familiar. We are, I think, a couple of things that probably makes us unique. First and foremost, we do all the investment management in-house, which is becoming more and more unique in our industry. The trend is to outsource that, but we not only do our investment management, but all of our financial planning in-house, as opposed to passing that off on a third party. And we really use a team approach to provide all of our clients with that boutique type experience. And I think finally, we take a really holistic approach to every relationship. Every relationship involves customized retirement planning, and really working with clients on all aspects of their lives. And this webinar and all the other webinars are a good example of that, the different areas that we're touching on. It's not just how do we manage your money, that's important, but how do we help you with things like charitable giving and Social Security planning and things of that nature. So with that being said, I will just put a caveat out there. If you see Chris or I looking down at our phones periodically, we're not trying to multitask on you. We're looking to see if there's questions coming in. But with that being said, Chris, I'll turn it back over to you.
Thank you. Appreciate it, Brad. As you can see, the great thing about charitable giving is it is a wonderful opportunity to do good and do well by doing good. If it is properly planned, good charitable giving not only supports charities that are important to you, addresses needs that are vital to the community, but can work in such a way that it provides you with a meaningful tax benefit. That's part of what we're going to discuss here. And there are a variety of different strategies that can be used, but they can basically be defined or broken down into 3 broad categories. So There are direct, immediate contributions. These are, and Brad's going to unpack them for you, but these are basically taking assets and immediately you've got the contribution, it is immediately received by the charity. So the contribution and the reception are identical. Then we've got direct deferred contributions. A direct deferred contribution means I give the money directly to a specific charity, but the giving, the contribution, and the distribution to the charity are separated. And we'll kind of unpack how that happens. And then the third are things called structured gifts. This is just a simple overarching way to break them down into broad categories because it can frankly feel a little overwhelming. We're going to walk you through the steps. One of the key things I really want you to keep in mind, a lot of what we're going to be discussing today are strategies that do significantly affect your tax situation. We are not CPAs. We cannot make this clear enough. It is vital for you to discuss any strategy with your tax advisor. Your tax advisor is the only one who knows how all the moving parts are going to work together to your best benefit. Now, we work closely with you and your tax advisor to make sure that everything operates accordingly. And a lot of times you don't necessarily understand the questions or you may not be comfortable with it. And we're happy to be part of that to expedite the conversation. With that in mind, Brad, go ahead and you can take a look at the, start to unpack the direct immediate contributions.
Sure. Thanks, Chris. And yeah, I can't underscore what you said enough about the CPA. And, you know, just to add on to that, I often find that sometimes we each will bring a little bit different point of view to the conversation, where I've been in meetings where the CPAs have said, oh, I really didn't think about it from that perspective because I'm so focused on the tax side of it. You know, I've just always found we get a better outcome when there's more people involved. But as far as the basic types of direct giving, and I'm just going to pull all of these up here. Cash is, I think, probably the the absolute simplest form of a gift. This is a gift that anybody can make, whether you're writing a check, whether you're dropping some cash in a jar or in a bucket somewhere. And although it's the easiest and the most straightforward, it's typically not the most tax efficient. And especially for the majority of folks out there that don't itemize on their taxes. And really, when the standard deduction went up to $25,000, that knocked a lot of people out of that itemizing category. The second option you see there is the qualified charitable distribution, or what they call a QCD. And this is where you're going to be able to give money directly out of your IRA. It's one of the most efficient options for IRA owners who are age 70 and a half or older. It allows you to take that money out of the IRA, meet your required minimum distribution for those dollars, and avoid taxation on them. And then the third piece or the third item would be appreciated securities. It's most typically done with appreciated stock, but it can be done with any investment. And it's one of the most efficient ways for people under the age 70 and a half make gifts. We just helped a client do this last week, a little bit younger client, but we gifted some Apple stock that he had a 350% gain in. So now that he's gifted that stock, the charity gets the money as if he would have written a check, but now he's got the ability to get out from under that 350% gain. And in his case, wrote a check back to himself to replenish his investment account. But in addition to some of these concepts, I think it's important to also, Chris and I were talking before the call, to look for what I would call kind of low-hanging fruit to maximize your gifting. And what I'm talking about is specifically opportunities for matching. And with today being Gifting Tuesday, there's a lot of organizations that will get big donors, or they'll get it underwritten where they'll have money that they'll put out there to say, any gift that you make to us up to $1,000 or $5,000, we're going to match dollar for dollar. So think about that a little bit like the free money you get from your employer on a 401k match, that sometimes these charities will do it directly, and sometimes, excuse me, an employer will do that. So something to think about as you're doing your gifting.
Great.
See if this will flip for me here. Well, Chris, it appears I broke it.
And we're trying, yeah, I've tried to move it forward as well. Thank you. But it's not, hopefully Miranda is in the background, our wizard behind the curtain. Yeah, it's not responding.
Well, let's press on. Let's assume that it was responding. What you would see next is a slide that really specifically dives into the qualified charitable distribution or QCD. And I think this is an option that is, I'll say, relatively new. It first made its appearance in 2006, and then it wasn't made permanent until 2015. It was kind of a on again, off again thing where Congress approved it year by year. One year, I don't think they approved it until the following year that people kind of made those gifts on faith. But what it does is it allows you to meet your required minimum distribution and avoid taxes on that distribution. So the one thing that I do want to note is that this is still available to people who are age 70 and a half. And age 70 and a half used to also be the required minimum distribution age, the age at which you were forced to start taking distributions out of your IRA account. The RMD age was raised to 72, age 72 by the Secure Act in the year 2000, but they left the QCD age at 70 and a half. So there's a little window there where you can still make use of that QCD, even though you're not responsible for required minimum distributions. The other noteworthy feature is that you can gift up to $100,000 per person through that qualified charitable distribution. A lot of people think that you can only go up to the limit of your RMD, but if you've got a smaller RMD, you are able to do more than that. So a married couple could, in theory, use $200,000 in QCDs. And I think some of the key benefits, go ahead, Chris.
Yeah, Brad, one of the things I did want to point out, and this is critical because as Brad noted, the QCDs are permissible at 70 and a half, but you're not taking RMDs until you're 72. So a QCD counts against your RMD, which you can kind of see here on this slide that won't move. It counts against your RMD, but if you're not taking RMDs, you have to be very careful about something else, and that is you're still permitted to make a tax-deductible contribution to your IRA if you're working, got earned income. Here's the issue. From the experts we've talked to, if you make a QCD and a tax-deductible contribution to your IRA, it is possible that part of your QCD becomes taxable. This is something you want to be aware of because you really probably want to avoid that. So just be attentive to that. So Brad, I'll turn it back to you. Yeah,
that's a great point. But I think at the end of the day, some of the real key benefits are it allows you to, I'll say, double up on benefits that you can, be taking a deduction for those contributions, even if you're still taking a standard deduction. So like I said, for so many people that don't itemize anymore, you can still take that full standard deduction and get, the benefit of making that charitable gift through the QCD. It can also be used as a tool to help you manage your adjusted gross income. So there's a lot of things that are impacted by that, like your Medicare premiums. And it can be something that can be used if you want to, push your adjusted gross income down for a lower Medicare, payment. This can be used as a way to suppress your income. And it will also reduce your future required minimum distributions. The one thing I do want to stress, kind of going back to that example about pushing down your adjusted gross income, all of the things that Chris and I are talking about today, these are really charitable giving strategies with a tax benefit, not the other way around. The charitable giving is really what should be, driving the conversation, not the tax benefit, although it makes sense to get as much tax benefit as you can while you're doing it.
Hey everybody, it's Miranda, the admin on the back here. Sorry, I had a computer malfunction Guys, what can I do? You want me to see if I can get the PowerPoint back up?
That'd be great. Yes, thank you.
Yeah, sure.
All right, you guys keep
pressing on.
talking. I'm gonna get this back up. Sorry, everybody.
Thank you. Thanks. Unfortunately, technology is wonderful when it works, and sometimes it doesn't. I think the common universal phrase of 2020 was "you're on mute." So that's sort of one of those experiences right now. But ultimately, to Brad's point, and I just want to reiterate this, when you give a QCD and you're in required minimum distribution status, so you're 72 or older, this does reduce your adjusted gross income, which has a direct impact. Just to repeat what Brad said about on the Medicare premium. So one of the things that we're always attentive to is there really are two different tax schedules, as it were. You've got the overt tax schedule for the IRS, but then you've got this sort of hidden stealth tax that is the Medicare premium. So we want to be attentive to, and we're always making sure in conversations with the CPAs and with your tax advisors that we're attentive to both of those things, because if we can help you to get down below that marginal bracket, which boosts up the premium on your, there we go.
Hey, wonderful. Miranda did it.
She's awesome.
Yeah.
But if you go up to the next step on your Medicare premium, remember the care doesn't change, it's just the premium costs more. So every step typically jumps by about $90 per person. So figure it this way, it's about 180 to 200 bucks a month more just because of enhanced income. So it can be a very effective way to give on multiple levels, but that charitable intent that Brad talked about is absolutely critical. So Brad, I will turn it back over to you. You've got it.
I think we're caught up now. So yeah, we hit on all the bullet points, and my children would have been horrified to know that I printed this out. Yeah, like the guy that prints directions. But every now and then it proves helpful.
Old school, you betcha.
So
there's a discussion there.
And so then the third piece that I had mentioned was gifting appreciated securities, typically appreciated stock. And as you can see from this schematic, there's a significant advantage to gifting the appreciated stock or a mutual fund or an exchange traded fund versus selling the position and then giving the proceeds to the charity. So in this example, you can see, the bottom line of about a $50,000 contribution, about 15% capital gains, and then way down there in the super small print, a 24% tax rate was assumed. But option one basically lays out if you sell that security and then take the proceeds and gift it to the charity. Option two is you gift the securities directly to the charity and then you allow them to sell it because they're tax exempt. They don't have any tax consequence. So two things really happen there. The first thing that happens is you get about an $8,370 advantage on the gift that you made from a tax perspective. And the second thing that happens is the charity actually gets a $6,750 advantage. So you get tax preferential, treatment, and the charity actually gets a bigger gift. The other kind of covert benefit for doing this is for situations where if you've got very, very old or inherited positions that you have absolutely no idea what the cost basis is, it allows you to avoid going through that nightmare of trying to determine, well, what did I buy it for 50 years ago, or what did my parents or grandparents buy it for, and then reinvested dividends, and you're never going to get it right. You can just hope that you're making a good guess and that the IRS won't come after you. If you take those positions and gift them, you get out from under that whole regime. And that's often our recommendation for positions that clients have no idea what the what the cost basis is. We have them set those assets aside for gifting purposes, because rest assured there's going to be a lot of pent up unrealized gain inside of those. Let's see if we're still working here. There we go. And this is a chart that we're certainly not going to go through in any level of detail, but this really drives home the point that Chris made for the need to involve your CPA in these conversations. There's a lot of gray. There's a lot of things that are going to come back to what your specific circumstances are. There's not a lot of broad rules of thumb that will apply across the board. It's really imperative, because there are just so many moving parts to determine what is the quote best way to make a gift. That's something that, again, we're happy to be part of that conversation, work with you and your accountant on that to come up with the best possible outcome. And also understand that it's not going to be static. It's going to potentially be different, year by year. So it's something that you really need to review each and every year. And Chris, you're going to talk a little bit about some of the deferred, the direct.
Yeah, exactly. So we've got the second category of giving, which is direct deferred contributions. So these are, we say direct, we mean you're giving to a specific charity. And we say deferred, it means that I'm making a commitment and giving a gift, but the charity's not going to realize the full benefit of that either for multiple years or until my passing. So as you can see, there are two general types. It's called planned giving in the development community and the fundraising community because it requires considerable planning. In the case of a long-term gift, you might say, hey, I want to make a significant contribution to a local university or to a charity, such as the ones that Brad discussed, I'm involved in as well, where we say we want to give multi-year gifts because that allows the charity to do planning, but also allows you to make a much more substantial gift, but it requires a long-term commitment. So you might have somebody who commits to giving 5 years. If you give 5 years worth of gifts at $10,000 a year, that's a $50,000 gift. That's a substantial, meaningful gift to the charity, but obviously it breaks it up into more bite-sized pieces for the person who's making the contribution, whether it's done through cash or it's done through highly appreciated stock. The second type is the kind where you put the charity in under your will. So obviously these assets would then not pass to your heirs directly. They're going to go to charity. So having a charitable commitment is really important. And if it's a sizable commitment, you probably want to talk to the development department at the university, hospital, museum, whatever it may be that you're giving, because it's great for them to recognize you. It's nice to be recognized, but I got to tell you also from the development experience I've had, it's important to them to be able to alert other people and let them know, look at what our donors are doing. It raises the sights for everybody. So it's not just about, hey, it's great to be acknowledged, but it stimulates and encourages giving in the broader community. So if you do consider a bequest, make sure to let them know. Be in touch with them. But that's the second type. The third type are structured gifts. Now, these require a lot of planning. Here we're looking at a particular type of vehicle that we set up where you're making a contribution, oftentimes with appreciated securities, and there is something that's going to intervene between now and the ultimate disposition of those securities. So let's take a look at this. We've got basically 4 broad categories. You've got an endowment, a donor advised fund, charitable trust, and foundations. Now the endowments and the foundations are very similar. In both cases, you're making a contribution. In the case of endowments, you typically can make multiple contributions over years, but you're setting them up as a specific pool of funds with a specific charity, typically. The money goes into a pool and then it gets distributed out to meet a particular need. Now, the neat thing about gifting at a higher level is you can actually designate the purpose of that gift. A foundation, if you want to establish a foundation, you've got 2 options. One is if it's typically over $5 million, you can actually establish your own foundation. This is where the big names that you've heard, the Ford Foundation, MacArthur Foundation, Rockefeller, obviously those are super big gifts, but you can establish them at a much smaller level where you have, as I said, 5 million or more, and then you're going to have to do your own reporting and your own compliance, your own distribution. But at 5 million, the costs start to make a lot of sense. If it's $1 million or less, the community foundations are an incredible solution. It's a one key stop. It's a fantastic way to do it. The donor advised fund and the charitable trust, though, we need to spend a little bit of time on because they are different. They're unique. But as I mentioned, these are complicated choices. They're irrevocable for the most part. You want to make sure a lot of planning goes into it, and almost certainly you're going to need to involve not only a tax advisor, but probably a lawyer. So that's the nature of a structured gift. Brad, I think you typically address the bunching here.
Yeah, absolutely. And this is a concept Chris, that as we really started talking about when the standard deduction was raised to $24,000 initially. And when the standard deduction went up that far, again, it really took a lot of people who used to itemize and turned them into people who were doing the standard deduction, which I loved when I would go to Community Aid or Goodwill and they said, do you want a receipt to write down how many pairs of socks you donated? No, I don't, because I'm going to take the standard deduction. But the concept with bunching is exactly what it sounds like. We're going to bunch a number of years of contributions into one. So this chart looks at kind of two regimes. And one regime is you're giving $10,000 a year over the course of 3 years for a total of $30,000 versus we're going to make that gift all at once, a $30,000 contribution that you either give directly to the charity and you let them know, hey, this is going to be 3 years worth of gifting, or the donor advised fund that Chris mentioned, you can put it in there and then spend those dollars out later as you see fit. But the idea is, you're really taking about what would be $945 of tax savings, about $315 each year, and turning it into $7,315 of tax savings by doing it all at once. And I think the biggest limitation to this would really be cash flow. This is an option that's going to be limited just to the people that have the cash flow that they could say, no, I can afford to do $30,000 all at once. But in those situations, it really does wind up being useful. And Chris, I know you're going to drill down into some of these concepts.
Yeah, absolutely. And one thing I do want to touch on, for instance, and this is why it's really important to work with a financial advisor who not only understands your situation, but all the options available to you. So one of the things Brad and I have done, last year, for instance, when the RMDs were suspended, we talked with a lot of our clients and said, hey, let's take multiple years. As you can see here in the illustration, if you just did 1 year, maybe you can deduct a little bit of it. Maybe $315 would exceed the standard deduction. It's not a lot. You're not going to get a lot of bang for that buck. So let's take 3, 4, 5 years, bunch them together, gift from appreciated securities. Now we've got this massive tax deduction. If I'm not taking my RMD, I can do something really neat, which is do a Roth conversion at a very low tax rate. Now, given all the moving pieces here, it's really critical to have your tax advisor very closely involved so they can identify that optimal Roth conversion. But it's a great way to be able to pull money out of an IRA at a tax rate that is extremely efficient, because you get to pick the amount and stay underneath that threshold. And this just not only takes that charitable gift you're going to give anyway, just compresses it into 1 year so you can get the maximum bang for the buck and do a whole bunch of other neat things in addition. So just one of the reasons why it's really important to work with your financial advisor to coordinate all of this, because there oftentimes are implications that go beyond just charitable giving and allow you to take real advantage of it. So that's wonderful. I mentioned before endowments. So if you can actually establish an endowment at your church, at your synagogue, at your local nonprofit, where you say, hey, I want to have a dedicated portfolio. I've got a specific designated need. If you do that and say, hey, I'm going to give a substantial amount of money, and typically it's a meaningful amount of money. Maybe it's, as I said before, a multiple year gift, but it gets you to that higher level. You can then establish a defined investment policy, how is this to be invested, and a specific spending policy. Ultimately, it's underneath the organization's direct oversight, and it's intended to be an enduring source of support. So the goal here is to set up a portfolio that will take care of the organization in perpetuity and address that need in perpetuity. That's an endowment. The donor advised fund is just sort of a simple, call it a retail off-the-shelf version of that, where I can put money in, and Brad mentioned this before. I put money into a donor advised fund. Fidelity offers them, Schwab offers them, TD Ameritrade. A lot of the Vanguard, a lot of these places offer these vehicles, which you can then, once you make your contribution, we talked about maybe making a 5-year contribution last year to take advantage of that suspension of the RMD, and then disperse them, as Brad said, at your will, at your leisure. The other neat thing is, if I put it in a donor advised fund, I can give it from there to any qualified 501c3 charity. That's wonderful. So I'm not necessarily making a choice up front. I'm making a tax choice and a charitable commitment, but I'm not necessarily making the distribution choice just yet. So it gives you a lot of flexibility on the other side of that. This is why it's separated or structured, because The contribution comes in at one time, the distribution goes to a different place or a different time, at a different time. So that's the
And
donor
Chris,
advised. Yes.
can I just jump in on one thing on that? And you and I talked about this morning. I don't think it went anywhere, but one of the appeals of the donor advised fund is that once you put that money in, you can give it out whenever you choose. And we've seen clients set them up for the next generation that may not be as charitable to say, here are dollars you have to give charitably. There was a bill introduced this summer called the ACE. You know, they all have cute little terms, but ACE stands for Accelerating Charitable Efforts. And basically what they were saying in that language was that you had to distribute the money within 15 years to get the upfront charitable benefit. I don't think it went anywhere, but I would imagine that it will come back up again, because even though charitable giving has remained steady, the amount that has gone to the end user charity has really declined since the advent of the donor advised fund. So just something to kind of keep in the back of your mind, that like any other tax rule, always subject to change.
Yeah, that's one thing about politics, is it will change. It's reliably unreliable. The last item that we've got here on this, at least this portion, is really the charitable trust. These are complex. There are two basic types. You've got what's called the remainder trust and the lead trust. Now, the charitable trust means that you're setting up a trust where something will go to charity. So inside of that trust, it tends to be very tax efficient. Let me go forward here. With the charitable remainder trust, I take highly appreciated assets. So if I've got, we've got a client who has a significant concentration in a particular stock. Whenever we've got concentrations, we become concerned about the level of risk that exposes you to. And if it's extremely low basis, there may be an opportunity to take a portion of that and put it into a charitable trust. Once the proceeds, or the shares have been transferred into the trust, they can be sold, and there are no taxes that are paid out of that. What I mean by that is, inside the charitable trust, it basically functions as a proxy for a charitable entity or entities. You get to have as many charitable beneficiaries as you want, as long as they're qualified 501c3 charities. But inside that trust, the proceeds can be sold, holdings sold, and there's no erosion whatsoever by capital gains taxation. So you preserve the entire corpus. That's huge, especially if otherwise you would be subject to the 23.8% tax rate with the Medicare surcharge. So we take a look at that. The proceeds can then be repositioned as needed, which again, if there's risk for the individual investor, reduces that risk substantially. Reposition it, but then you have to be very careful, because you're making a lot of choices. Typically, a charitable remainder trust has what's called an income beneficiary and a remainder beneficiary. What qualifies it as a charitable trust is the fact that the remainder beneficiary has to be a qualified charity or charities. We just did a number of these last year, put very highly appreciated securities into the charitable trust, but the grantor, the person who donates that, then has to make an election about who gets the income. These pay out income. They pay out income for a term of up to 20 years or lifetime or 2 lifetimes, which would be typically a spouse, partner. So you've got this lifetime payout where you might say, okay, you can pay out 3, 4, 5, 6, 8%. You can pay out even far more than that. But there just has to be a meaningful amount that remains for the anticipated benefit of the charity. Here's the cool part. You take the highly appreciated stock, you put it in, you sell the position. The proceeds are unaffected by any taxation, so you're still working with 100% of the money. Then it begins to pay out immediately for that year and every year thereafter, a percentage. That's what a charitable remainder unit trust does, is it's based on the percentage of the value of the assets at the end of the prior year. So if you say, I want to have a 6% payout, then every year, at the end of the year, it calculates the value, and 6% of that value is paid out over the course of the year. Once you pass, and again, supposing that you've got it set up for 2 lifetimes, your spouse passes, that money goes to the charity or charities that you've elected. It's critical to keep this in mind. It must go to charities. That's an irrevocable disposition of the assets. They're gone. They're not part of the estate. They're not going to your heirs. The cool thing about this is you get a substantial tax deduction for that contribution to the charitable trust based on the anticipated future value. If this sounds complicated, it is. That's why we have the tax advisor and the attorney calculate the potential tax deduction for you. So I'll give you an example. We put $1 million into a trust. We take an 8% distribution. You might get a $300,000 or $400,000 tax deduction. That is massive. And you can use that to offset all sorts of other things. Now, if you can't use it all up in 1 year because of limitations on charitable tax deductions, you can roll it forward. You've got a period of time where you can roll that forward. So you get a real tax advantage right now, plus you avoid any taxation on the proceeds. So there's no capital gains inside the trust. And then ultimately the money does go to a charity. So here's how that looks.
And Chris, there was one question that came in just verifying that that in everything that we're talking about requires that the charity be listed as a 501c3. And yes, absolutely, that is the case.
Thanks, Brad. Yeah, so typically, again, churches, synagogues would qualify as that sort of thing. Your well-known nonprofits, anyone that's filing with the state, because a 501c3 is a state, typically with all of their own tax ID, that sort of thing. So you can see here, step one is you make the contribution. Again, typically it's super low appreciated, or as Brad pointed out, we have no basis. Put that money into the charitable trust. Imagine it's $1 million. It goes into the trust. It's sold. There are no capital gains on those assets, not inside the trust. Once it's sold, it's repositioned. Step two, every year from that immediate contribution, every year going forward, you're paying out a set percentage. You define the percentage because the percentage ultimately determines the remainder value or anticipated remainder value. So you've got this income stream that's pouring out to the income beneficiaries. Upon the termination of the trust, either 20 years at the most or 2 lifetimes, the money then goes to a charity or charities, and you can change the charity, so you're not necessarily locked into one particular charity. But this is going to be a meaningful gift. So again, I tend to recommend that if you're that committed to a charity and you have them as a remainder beneficiary, that you alert them and let them know. It'd be nice to be recognized, and again, for them to broadcast it because it stimulates other giving, which is a very cool thing. Now, this is called the Charitable Remainder Trust because the remainder goes to charity. The income goes to you. Charitable Lead Trust is different. You take an appreciated asset. This is basically going to be a gift to your heirs. But for a period of time, and you define the time, income is paid out to the charity. And if you hold it long enough, the value of that ultimate gift to your heirs may be zero. Because if the income that's generated over that period of time, it reduces or counts against the transferred value of that asset to your heirs. It's a very cool way to move excess assets over to heirs. Obviously, in both of these cases, it's critical to keep in mind, there you go. It's critical to keep in mind that this requires a lot of very careful planning because it is an irrevocable decision. Once you've done it, you're not reversing this. And again, some of this, whether it's the income in the case of the Charitable Lead Trust or the remainder in the Charitable Remainder Trust, that goes to charity, just to keep that in mind. So here's kind of how that works visually, a little more linear. You've got the ultimate donor, you're the grantor, you've got highly appreciated assets, you put it into a trust. The income goes to the charity in this case, they're actually step two, and the remainder at the end of that term goes to the beneficiary of your choice. Again, if the income is sufficient, you can actually reduce the value of that gift to very low or nothing if it's substantial enough. You've got that income over time. It reduces the value. The income paid out reduces the value. But as you can tell, in either case, there are multiple choices that have to be made. Ideally, this is like a bespoke suit. You want to structure it so it tailors to your specific financial situation perfectly. Multiple pieces moving. It does affect your estate plan. So typically, we also recommend that you do want to work with a seasoned trust and estates attorney, somebody who's done this, who knows what they're doing. I will tell you that if you get it drafted, it can sometimes be very difficult to fix after the fact. This is a case where it's definitely worth the upfront cost to do it right. So that's the critical part about structured giving. As I mentioned before, and I touched on this earlier, foundations are basically, they're going to be tax exempt organizations. They're designed to make sure that anything that you contribute, that you establish as a portfolio, is able to continue in perpetuity. One of the things I love about foundations, and again, whether it's a private foundation, that you set up. You pay for the attorney, you pay for the accounting fees. And again, at a certain level, that just makes good financial sense. At a different level, those community foundations are absolutely invaluable. But the wonderful thing is it's a great way that, as Brad mentioned, maybe the next generation is not as charitably inclined. Having it involved, so this is multi-generational, so they're involved in the decisions. They get to see the impact of these gifts on the community. Typically, it involves multiple generations in a way that allows them to start to catch the fire of what it means to give to the community and to recognize the needs in the community. This is why you'll see this with multiple of the wealthier families where they're very actively involved in charitable giving. So tremendous benefits for the individual who participates on the board, which would be family members, as well as for the gift and what you're actually doing for the benefit of the community yourself. That's foundations.
Hey, Chris.
Yes.
What would you say would be in a round number or ballpark from your experience, a dollar figure at which you would want to consider that private foundation? Where does that become scalable?
Great, exactly. So if I'm looking, and I want to be very careful because it depends on the attorney that you're talking to, but most foundations are community foundations, which is what you're seeing here, are going to charge 1.25%, 1.5% per year. So it's really a matter of looking at those totals and saying, does it make more sense for me to use a community foundation because I can't afford to pay an attorney and an accountant to do all the compliance work? Or does it make more sense? And typically, you know, 3 million, it starts to become debatable. By 5 million, it typically can make sense to use to set it up and have your own private foundation. Can make sense doesn't automatically mean that's what you want to do. So you may still end up wanting to work with a community foundation because of the durability of that institutional structure. You don't have to worry about who's going to be there, who's going to take care of it, who's going to hire the next attorney. However, the costs, once you get to that level, frankly, are less expensive on the private side, and you have complete control over everything. Once it goes to a community foundation, once it's there, it's there. But boy, they do great work. We are very strongly involved with the Pittsburgh Foundation. It has done phenomenal work, taking care of and meeting so many needs, helping those who have means to take care of those who have needs. It's a tremendous way to do it, and it creates real accountability. And they're very attentive to the current needs. So if there is a change in, for instance, an organization's purpose or structure, they will actually do research to find organizations that, again, fit the original mission and mandate of the endowment that you might have set up at that community foundation. So obviously, it's great to have something that exists in perpetuity. So great question, Brett.
And they also know where the needs are in the community, that if you don't have a specific goal, they can fill what they see as being the most needed area in the community.
Absolutely. And it is a turnkey solution, which is the great part. So they take care of everything. Is it worth the premium? Again, at a certain level, you may be able to do it a little more efficiently, but it ultimately all is on your shoulders. And this is invaluable, as we mentioned before, for multi-generational efforts because it ensures continuity. And it really allows the heirs, your next generations who might participate in this or who you would direct to participate in this. You always probably want to have a family member who's the original contributing family involved so that they can oversee the efforts, but the heavy lifting is done by the community foundation. So
just two quick follow-up questions on the other. One is, can mature double E bonds be used to fund a charitable remainder or charitable lead trust?
That's a great question, especially because those are always subject to ordinary income tax. I will have to defer that to the tax advisors.
Okay.
Serious doubts about that. Usually,
yeah.
At least for instance, in estate planning purposes, you still end up paying the taxes. So.
Well, that's a circle back with your accountant question.
Absolutely, circle back, yeah.
And then the other one is for the charitable remainder trust funding. What is the tax effect of securities that have capital loss or capital gain? Well, I don't think you would want to fund it with one with a capital loss. You want to keep that for yourself.
That's exactly right. It would serve no particular advantage that I can think of, none, to use a capital loss. You really want the most highly appreciated securities you've got. So if you've got, we certainly have examples of clients who have 10,000. I'm not kidding. You've got this massive gain because you've held it for a couple decades. And this is a wonderful opportunity to avoid paying excess taxes. If the new tax law goes through, and we are looking at a heightened capital gains tax rate on gains in excess of $1 million, that's the anticipation, but again, it's politics, so who knows. Then, for instance, business owners will want to make sure before they sign a letter of intent, and this is critical, before you sign that letter of intent, you will want to make sure to start looking at doing gifting, because that can be substantial amounts of money that can significantly reduce the taxation on a particular business sale. But again, highly appreciated securities works really well. But you want to maximize the bang for the buck. So not only are you getting a wonderful contribution on the current value of the gift, but also avoiding capital gains on the appreciation, as you pointed out, Brad. So that's the first thing. So private foundation, we've kind of talked about it already. The idea is that, hey, I've got a specific pot of money. Typically, by the way, foundations are established by not recurring contributions, but one pot of money. Once the money's there, they set it up. It's going to have ongoing distributions. The idea is to make gifts in perpetuity. But if it's private, as Brad pointed out, you've got to know that you've got to have somebody who knows the needs of the community, who can make the distribution disbursements and know who needs to receive them. That sometimes is where a community foundation just proves invaluable. The other thing is that you can use almost any asset. So again, without going into detail about the EE bonds, you know, you can do private equity, you can do art, you can do real estate, you can do all sorts of things. So you've got a lot of flexibility on the control of the assets, on the investment of the assets, and then on the distribution of them. So it's always nice to have control, but it comes at a cost. So wide array of things that you can do. And again, with private foundations, I'm not limited to a particular community. We can do international gifting. You can direct it to other related activities or nonprofits. They aren't necessarily immediately charitable, but they are nonprofits. So, okay. Move beyond that. So Brad, we've got some stuff coming up.
We do, and I think we've kind of been handling the questions as we've gone along, so I don't see anything in the queue, but do want to put a plug in. Wednesday, December 15th, we're going to be doing a webinar in partnership with Penn Live, which is kind of our local newspaper, their online presence, and Dan and I are going to be part of a panel on navigating finances. And also put a plug in for all the webinars that we've done historically. If you go out to our website, at the bottom of the page, we've got a little button for a YouTube channel. And if you go out there, you can see all the ones we've done in the past for things like Medicare and Social Security and you know, just all kinds of, you know, things like that. And I think if we, obviously, please don't hesitate to reach out to us with any questions. And then I think there is the ever-present,
Yeah, we're looking for
disclaimer. Miranda's going to fix it. There you go. But for my part, I mean, I really appreciate everybody's attendance and participation. And Chris, I'll let you kind of wrap it up.
Thank you. And again, just like Brad said, we're grateful for your attention, your time. We hope this was constructive and informative. We are always here. Obviously, we've kind of touched the surface. There's a great deal of planning. We run scenarios, we run projections before we do anything to make sure that this works for you. Beyond this, one of the things Brad had mentioned at the very beginning was his commitment and his involvement with the various charities in his area. I have been working very closely with, it's very close and near and dear to my heart, Light of Life, which is a rescue mission working with some of the people that are struggling with life's more difficult challenges and giving them a way forward. Light of Life is just a wonderful group. As I said, this goes to my heart. Beyond that, also working with Wesley Family Services. I have personal experience with the tremendous value that they provide to children who are on the spectrum or who have other challenges and needs. And again, in both cases, we're talking about some of the most vulnerable people in society. So being able to bring resources to them and to support them in their efforts is just, it's a godsend. Brad and I were talking about this before the webinar began, and it has been wonderful to see people recognize this past year during COVID just how threatened these are very fragile communities. These are the ones who will feel the impact the most and have the most adverse consequences. To see people step up. The boards I've been involved in, we have seen a wonderful outpouring So thank you for those of you who continue to contribute, who have taken advantage of some of these strategies that we've discussed. We would love to work with you going forward. The need remains. If we continue to have variance, and it looks like we will, we don't see that changing. So if you have any questions, please reach out to us. Fort Pitt Capital Group, we are dedicated to helping you have the very best advice and make the most of your assets. And again, feel free to reach out to us. It's been a delight.
Thank you. And I think with that, we'll sign off.